The NBFC space is buzzing for the last couple of days on the market. Several names have been doing phenomenally well. One particular name where the street is focusing a lot of good things are being heard about is JM Financials. And I am in discussion with Vishal Kampani of JM Financials to talk what's happening in the company. How does he observe changes in the sector and the opportunities which lie ahead? Vishal, thanks so much for joining us today on ET Now.
Thank you. A pleasure to be here.
So Vishal, the NBFC space has seen such a lot of turmoil in the last couple of years. And now we are seeing the sectors coming back, rebounding nicely, and credit growth is hitting 18%. Not many organizations in India have the kind of vintage which JM Financials brings to the sector, almost several decades, running into decades. Next year, you'll be 50 years in business. Talk to us about uh, does the strength look durable?
No, absolutely. So I think we've seen a negative credit cycle for a long time in India. You've seen issues with the PSU banks in the last decade, followed by demonetization, which created some issues for microfinance lenders, the small finance banks, followed by ILFS, which created a havoc in the NBFC liability side, which flowed through on the asset side. And we've seen a couple of failures. So there has been some kind of a discord, right? Whether it's regulatory, whether it's trust on the liability side, and how is the sector performing? And I'm very pleased to say that as a sector, we've only come out stronger, much stronger. Today, it is actually the NBFCs where you see a lot of innovation. The NBFCs who have deep reach into India. NBFCs are bringing a lot of new to credit customers, right? And they're actually fueling a large part of the credit growth. Even if you split apart the growth on the banking side, a lot of the incremental growth in lending is to NBFCs. So I think it is a very important sector, very core to actually attaining our growth in GDP, our PM's vision of 5 trillion. The NBFC sector will play a very, very important role. We're extremely bullish on it. We've kind of come out untouched. Our ratings are completely intact. We have a model which is 50% lending and 50% fees and commission. Our lending book has performed very well in the last 5 years. We took adequate amount of provisions, and now we are looking to a phenomenal growth curve in the next 3 to 5 years. Just year on year, last year, we've grown our book at upwards of 30%.
Yes, sir. It was very clearly evident in your last couple of quarterly results as well. And the street is talking about it. So I'd like to ask a very pinpointed question. The street is very curious to know, after looking at the amazing set of numbers, that it appears that there's a transformation which is being attempted at JM now, readying it for kind of a JM 2.0. Next couple of 3-5 years, we are talking about, the 10-year plan, the golden decade for India. Talk to us, what are your areas of strategic focus at JM for that journey ahead? Because you come with a lot of amazing vintage. You know the business sector, business cycles. What does lie ahead for the company?
No, absolutely. We'd love to do that. So I think the way we think about our business is really corporate and institutional, the franchise that we've had for 50 years, and what we are building on the retail side. And the way we divide up the segments is into 4 buckets. We have the first bucket called the investment bank. And here we cater to our corporate and institutional customers, including some very high net worth investors, right? And we want to bring all our products, right from being able to do portfolio management services, all the way to doing an IPO for a promoter or M&A advisory, or on lending from our balance sheet to him, right? So we have a plethora of products that we've put together. We've got very driven management. We have CEOs for each and every business. And what we are doing is we are working closely with our 50-year history, with the relationships and the trust that we have with these 3,000 corporate promoter families of the country to deliver an integrated investment bank approach to them. Right, so this is the franchise, sort of the core of the JM brand. Second is what we are building in mortgages. We're building construction finance, structured credit to real estate, retail mortgages in terms of first home loans, as well as loan against properties. This book currently stands at close to 10,000 crores, and we estimate will grow by 50% at the minimum in the next 2 years. So we see this at 15,000 crores. We think we understand real estate very well. We've been in the space for almost 10 to 12 years, and we see a lot of scope in terms of new project underwriting from a construction perspective, new project acquisition, where weaker projects are changing hands to some of the stronger players, and we provide the acquisition finance as well as the whole growth in affordable housing, as well as MSME loan against property. So, we've spent 6 years now on the retail side and almost 15 years on the wholesale side in this space. So we've put that together and we call this the mortgage finance business. Our third is our alternatives and distressed credit business, where we have an ARC. Again, IRC seen some of the deepest challenges, right, in the last 5 to 6 years. ILFS, COVID, we've only come out stronger. We have a target recovery sort of amount that we set every year, and we've been meeting it even through the crisis. We've met it almost every year. And even in that business, now we've started adding new assets. One challenge in that business has been a little bit of slow functioning of NCLT. We wish that our recoveries could have been stronger and faster than planned. And second, the credit cycle is too sweet right now. So we have to watch out where will we get our assets from. So the asset flow is not as robust as it was in the last decade. But again, we're a pioneer. We understand the space very well, and we will be here in the long term to stay. And our last business, which excites me the most, is actually our platform AWS business. What we're doing here is we're bringing all our retail touch points, whether it's equity broking, whether it's elite wealth management, whether it's financial product distribution, direct as well as through IFDs, as well as our asset management, mutual funds, PMS play. We're bringing it all together under one roof and rapidly digitizing it.
Sure.
Right? So we bring one platform, we take all our products and go out to the heartland of India, not just the urban cities where we are very strong. And we want to do that as a highly tech-enabled player, integrated tech-enabled player.
So that's quite an integrated approach which you just spoke about. But 50% growth, that's a kind of quite an aggressive number. Let's go back to that NBFC piece a little bit more. I've also observed that though ever since you came in on the board to 2016 onwards, if I'm not wrong, there have been multiple occasions I've read you're focused on profitability-led growth, not just the top-line growth. So within that piece, when I see your latest results or even the annual results as a whole, the year gone by, you crossed 700 crore. And when you say integrated approach for building the business from here on, how would be the mix of profitability be, and what are the levers which you have to press to reduce the cyclicality component also one end of your business has?
So that's a great question. So, if you go back a little longer in history, if you just go back more than a decade ago, our lending businesses contributed less than 10% of that. So we've already got that number to around 50-55% of that. In fact, almost touching 60. So that itself reduces cyclicality massively. Now, what happens is because 40-45% of our business is directly or indirectly related to capital markets. Even in that business, we are seeing a shift. We're adding more wealth management products.
More fee-based.
More fee-based, more granular, sticky, more annuity, not linked to one large client who pays us a big fee and then is not giving us business the next year, right? So I think we've already achieved that. That transformation is already achieved. So our revenues in our investment bank are a lot more granular on the client side as well as the product side. So for example, if you look at our 6-month numbers, a lot of analysts expected that because the capital markets will be slow, the numbers will come down. But our debt capital market franchise, our wealth management franchise produced fantastic returns in the last 6 months, both in terms of origination of new product and distribution. So what's happened is that the cyclicality within that business has reduced because of a more larger, broader client base and more products. Now on the lending side, we are in a very unique position. See, our debt to equity is very low, right? So we are earning almost 3.5 to 3.75% ROA, and our debt equity is 1.2 times.
There's huge scope for that to go up.
So we can easily take that. I mean, we don't even need to take it to where CRISIL or ICRA, our rating agencies, allow us to go to 4 or 5 times. We don't even need to get there, right? we get to 2.5 to 3 times and we are banging at 16 to 18% ROE.
So, but one is aspiration of the company or the top management, one is potential of the book. Your potential current balance sheet size gives you to take it up the leverage very high. But where would your aspiration be?
Yeah, so
Somewhere in the middle?
I don't think we will hit 4 to 5 times debt equity. I think as a house, we've never taken our debt equity more than 3 times. I think that's where we'll be. And the reason we can still produce a better ROE, even being at 2.5 or 3 times leverage, is because 40% of my revenue is still fee based.
Sure.
Right? So we are also focusing very deeply on investing into that revenue pool to grow at 20-25%.
Sure.
Right? So even if I'm operating at 4% ROA, which happens when the fee cycle is doing very well, we also hit 4.5-5% ROA. Then my ROE can be at 20% if I'm hitting leverage of 2.5, 3, and a very strong sort of fee-based momentum in the market. And I see this happening, right? You look at it from a per capita GDP perspective, where we are compared to China or the US, right? As well as just the sheer momentum of India wanting to have financial savings. I'm seeing a 10-year boom across our businesses, a boom that we have never seen in the 50-year history of the firm.
Excellent. I would like to, scratch that point a little more. Just to sum up this point, you're talking about taking the leverage to around 3 times, and you would be very happy with 3.5% ROA, and that should give an ROE of near 18%. That's the kind of number you would like to work in going forward. Uh, Talk to us about the longer term point, which you said 10-year. You see a very good runway for all the businesses. That's where you're focusing on. What are those signs? Because nobody else, or very few organizations, are plugged into the corporate ecosystem so well as the big HNI community where flows are coming. What makes you so confident of that?
Yeah, so I think a lot of things, right? One is Indian corporates, they are in the pink of health.
Okay.
You go back, and we've been dealing with these corporates. I mean, since I joined
Correct.
work, and I've been dealing
In your
with
cradle,
corporates.
I would say.
So, they are in the pink of health. Leverage levels all time low, right? Just the business outlook, the kind of talent they've recruited to be able to grow, whether it's, greenfield or brownfield, just their understanding of global markets, the orientation to growing exports, right? The orientation to global trade, the orientation on costs, the orientation on integration, right, among their businesses. So when I talk to corporates, I think we have these 2-3 thousand companies in India, which I think are some of the finest companies in the world.
The universe of your clients in a way.
Absolutely. No,
Otherwise, also.
yeah, I mean, we have 500-600 clients, but we're targeting these 2-3 thousand.
Sure, the potential.
Second, a lot of the companies that are going public today, they're largely private equity invested. Just think about it simply, right? Private equity has put more than $100 billion into this country in the last 6-7 years. All of that's going to come for harvesting. Private equity is looking at 20% growth, right? So $100 billion compounding at 20% over 6 to 7 years is $200 billion worth of new companies.
No.
Which are not even listed. They're all going to list over the next 4 to 5 years. So you are seeing a US-like phenomenon of the 70s and 80s, and a China-like phenomenon of the 90s and the 2000s to happen in India in the 2020s and 30s. And look at the SIP flows.
Crazy.
I mean, almost hitting $2 billion a month at times. Very steady at 10 to 12,000 crores. So this is like unbelievable. This is the golden age for our business here.
If they are saying that India is a shining star right now compared to so much of gloom and doom across the world, it is justified that Indian markets are trading at much more premium valuations because of the superior earnings growth Indian corporates are showing up, right?
See, I'll give you a simple example. Just look at the FMCG and consumer space in India, right? It's been expensive for 14-15 years now. But the companies have done very well. The companies produce 30-40% ROS, right? They're growing revenue at between 10 and 12%, very high ROEs, great payouts. Look at IT services, right? You have stellar companies which have done extremely well in the last 20 years. This is what is going to happen to manufacturing in India. Is going to happen to many sectors within manufacturing. It's not just China plus one, it's Europe plus one. Right? Look at a company like Ambuja, owned by Indians, owned by Europeans, owned again by the Indians. Right? So, it's phenomenal, I think.
So, out of the universe of companies you do business with, where are you seeing the highest amount of consumer business confidence when you talk to the CEOs or promoters? Visibility of earnings growth very robust. Any thoughts there?
Manufacturing. Very, very strong trend in manufacturing. Exporters. People targeting certain geographies. For example, let's take Europe. Pick Europe. ESG issues, sustainability, environment, right? They can't produce. Second, companies which have international companies that are overly reliant on China for their raw materials. There needs to be a China plus one. So manufacturing is seeing a clear, steady 20-25% kind of growth rate over the next 5 to 7 years. But to focus on your question, I think we're seeing bullishness everywhere. It's not just one sector or two sectors. I think the India story is very, very robust.
What are your thoughts on the mid-tier companies? Companies which are 3-4 years away from IPO right now are negotiating deals with private equity, or the smaller companies which are raising capital or keen to raise capital and become bigger in 3-5 years. Does that size of opportunity also excite you?
Of course, and we are very focused on it. In fact, that is very exciting. So as I said earlier, our client set's getting granular and our product set's getting wide. So we are looking forward to these new 500 companies that will list in India over the next 5 to 7 years, because it's just clear client addition. In fact, we are going one step before. We are trying to do the private equity transactions for them. So it's not just about IPO. We want to work with these promoters and these clients in their startup phase.
You also work very closely with a bunch of smartest investors, not only in India but abroad as well. When they are scanning the investing landscape here in India, and what your help or the organization's help, what are the opportunity sets they are eyeing, and what excites them, what depresses them?
So I think, see, most foreign investors are focused on risk-adjusted returns. One big thing that has happened for India is that the relative risk of India as a geography, whether it's political, ease of doing business, right, transportation, logistics, infrastructure, the relative risk of India compared to many other markets has gone down. And if that trend continues, the risk-adjusted returns for these investors are higher. It's not about making 25 or 30% return. They are happy making 15 to 20. They just want less risk. Right? And that is exactly where India needs to keep focusing on. So the opportunity is risk-adjusted returns, and there are funds who are sector-focused. You may find funds who only want to focus on financials or focus on consumer. But in my last trip to New York, back in September and even in July, I would have met at least 7 to 8 funds who are all planning ex-China, ex-Japan, Asia funds with a 40 to 50% weightage on India.
So dedicated money is looking here.
Absolutely. And one investor actually quoted to me that he can't find more than 50 companies, even in a geography like Indonesia or Malaysia. India has 5,000 companies to choose from. 2-3,000 listed, another 2-3,000 unlisted. So it's a huge geography. It's a big GDP. It's a big country.
So investors spoiled their choice in India.
Absolutely. Actually. But see, again, investors, they don't have to invest. As I said, they have to see the risk being low. They know how to find the returns. And I think that our Prime Minister, our Honorable Prime Minister, is doing a fantastic job at keeping risk low.
Of course.
India is safe, right? India has credible law and order, right? And your investments are safe, right? So, and if you're investing in infrastructure and logistics as a government, right? I mean, you're building roads, you're building ports, you're building transportation. Why would you not, have more foreign investment come in?
Okay, tell me one thing. So all these ingredients which you're talking about, the business confidence of the businessmen you work with, the business owners, industrialists, government's own moves, and the way India is now uniquely positioned, does it appear that we have ingredients for a sustained kind of a structural bull run, of course with their own share of corrections, but the roadmap is slightly longer.
100% absolutely believe that. And haven't we already kind of seen that the last 10 years, despite all the issues? So I'm pretty sure we're not going to face even like 20% of the issues we've seen in the last 7 years in the next 7 years. And see, that is kind of reflecting in the market valuations, right?
Sure.
See, the market's always forward looking, right? The market's looking out at least a year to 2 years. And you're seeing that in the market valuations. You're seeing that in the balance sheet.
So you're part of the business which is also focusing on elite wealth, the number of HNI investors in our country and the way they look at equity is also undergoing a lot of change. Now you're also building a platform to go to the smaller towns via retail broking arm. So tell us the investor sentiment of that pocket towards the markets.
Oh, it's very positive. But I'll be concerned about one thing, that I hear that people are borrowing more to consume, right? Which is fair, but they should not be doing that by putting their savings into the equity markets. See, there has to be a proper sort of asset allocation. So our approach in elite wealth, our approach when we go down more deep into India, is to actually take a good asset allocation create a good asset allocation profile, right, for these investors, because they're not necessarily as smart or as savvy or as long tenured in investing compared to the urban cities. See, the top 10 or 20 cities, they're getting smarter fast because of digital, and all of the marketing. But still, see, you have to have your savings well diversified, and you don't have to over borrow so your savings multiply in the stock market. So that is one thing that sometimes concerns me. But it's about horizon, right? I mean, if you have a horizon of 3 to 5 years, I think it's still good.
So how much of this positivity is reflected in the stock market already? Because there's one pocket of the market who believe that Indian markets are expensive and are not really giving a very good entry point for beginner investors or startup investors who are starting off. If we take a 3-5 year view, do you find them expensive?
No, I don't. So again, as I said, it's horizon, right?
Sure.
So of course, if someone has invested 6 months ago and already made 25% in the market, he's going to find it expensive. But if somebody's a 3 to 5 year horizon and he's not investing all his savings at one shot, it's like an SIP. He's doing it systematically, right? He's not going to lose money.
So I'll end my discussion with you on that note, which you said that you've not seen the quality of balance sheets of corporate India. They are in pink of health, and you're very happy to see them. And when you talk to them related to transactions, we are also a couple of weeks away from the budget as well. Taking into account that a lot of reform related work